So here's the reason why when I hear all these answers from the students, it just doesn't make sense to me, because the market does not care about your pain level when it comes to how much money that you're okay with losing versus how much money that you can't lose. I know it's tough to say that, but you just have to say it. The market doesn't care about that, okay? You care about it. I care about it. Everybody else cares about what we don't want to lose and what we can lose and all that. Even though that's not the right approach, but I have to use those words because that's what people use a lot, right? In order to explain this series. But understand something, the market has no idea and does not care about your pain level when it comes to how much money that you get a lot of pain from when you lose that amount of money, or how much money that you get very ecstatic about when you make that much money. The market doesn't care about that, right? So because of that, placing a stop based on the amount of money that you don't want to lose on a particular trade doesn't make any sense, because it's not flowing with what the market wants. Because remember our philosophy, we always listen to what the market is telling us to do and follow that, rather than have the ego about wanting to be right, or saying this is what I think should happen and therefore I'm going to continue to hold on to a trade or continue to do a trade that's not working. That's not how we trade. We listen humbly to the market, right? So understand that placing a stop based on how much money that you don't want to lose doesn't make any sense. Even though there could be gurus out there who say that's how you should do it, or there might be books that say out there that say that you should do that. Understand that when you place a stop like that, you're more likely to get hit on that stop, because it doesn't make any sense. It doesn't flow with the dynamics of good trading, okay? The other way of placing a stop, where some people say, well, I don't want the market to move 5% or 10% of its price. Some people say that. And I can't believe they have the audacity to say that, right? Because if you really can like breathe in and understand how immense the market is and how amazing it is, and then for you to sit here and say, well, I don't want the market to move more than 2% inside this day, or I don't want the market to move more than 5% inside this day. Not even 5% against your equity or against the value of your account. It's saying 5% in the price action. That is baffling to me, because it's like you saying to a massive entity that is limitless that you're now going to come to play, and now that entity has to follow your rules. That doesn't make any sense. Okay, and most of the time, the people who say that are the people who put very small amounts of money into the market, like maybe 10,000 or 20,000 or 5,000 or 3,000 in the market. Those are the individuals who say, well, I don't want this particular market to move more than 5%. If you just listen to that sentence, you'll see how nonsensical it sounds when you take that as your main way of placing a stop, because it's not going to work. And these are the same individuals who will continue to complain or talk about, hey, my stop gets hit all the time. My stop somehow gets hit. I don't know for what reason, but whenever I place a stop, it gets hit. That's what they say. It's because they came to the stop in the wrong way. They came to the rationalization for the stop is not the correct way, okay? And I've just explained to you these two main things. So one's called what we call an equity stop, where people call like to say a technical name for that. It's called an equity stop, where they say, well, I don't want to lose this much money, and that's why I place that. Wrong way to place that stop, because the market doesn't care about how much money you can lose or the pain that you go through that, right? And the other thing is saying, well, I don't want the market to move this much, and therefore I'm going to put the stop here. The market doesn't care about what you want it to do, okay? So now, when you eliminate that approach, which is a weak approach of placing a stop, an ineffective approach of placing a good stop, what is an effective way to place a stop? Let's go back to my initial definition, right? of a stop loss order. A stop loss order is any type of protective order that you put in place that if the price action of a particular order nullifies the premise of why you got into that market in the first place, that's what a stop loss is. Any price action that nullifies the premise of why you got into that market is where the stop should be placed. Like, for example, I'll put this into like a real world scenario. Let's say if the crude oil market or the gold market or whatever market you're trading, let's say if it closed over the 10-day moving average, and if that was one of your three mathematical confirmation signals to enter a trade, then that market should not close below the 10-day moving average again. Do you understand that? At least for the next few days or however long that trade's going to last. Does that make sense? So your stop has to be below that level, okay? Because that was your mathematical confirmation to get in, and that was your premise of why you entered the trade. So therefore, you don't place the trade, after you get into the trade, you don't say, well, if the market moves, 2% against me, I'm going to get out. Or if I lose $500, I'm going to get out. No, none of that makes sense. Because why did you get into the trade? Because the market closed over the 10-day moving average. I'm giving an example if that's it. So your stop has to be underneath the 10-day moving average. That's just an example on trying to explain the definition that a stop should be placed at a place where the price action nullifies the premise of why you came into that trade, okay? The other thing that I'm going to mention here is, let's say you've gotten into a trade on a daily chart where the confirmation has come in. Remember in my previous video, we talked about the confirmation. Like once you get 3 mathematical confirmations, I enter a trade, right? Because I feel like I have had strong confirmation now to get into a trade. So what you do is, let's say on a daily chart, if the market begins to move in your favor, then you would have a certain entry point. Like for example, on a 4-hour chart or a shorter term chart, you would have said, well, I now got in over this level. So the market should never close below that level. Do you understand that? Because that again nullifies the premise of your entry. That way, your stop is now placed based on price action of the market, because you got in. So this is an important point. You got into the trade because of the price action of the market and how it unfolded and how it confirmed, right? So then the stop is placed underneath that price action confirmation. So what you're saying is, if this market, which you can't control and nobody around you can control, if it now for some odd reason comes back below that confirmation that made you get into it, you want to be out of it. And you want to be out of it as soon as possible if it does that. And don't ever regret that, because you'll see that when you get out of it, the market will continue to go against you and you would be relieved that you got out of it. Okay? And this goes back to something else that I say that's very important. That is, if you're going to get kicked out from a market when the premise of why you got into it has been nullified, the earlier you get kicked out, the better, after that premise has been nullified. Don't continue to regret why you got out. It's fine, because that's what's supposed to happen, okay? And this is another change in the mentality that people have to develop about stops. It's okay to get stopped out. So the next question is, so what do you do if you get stopped out? And what happens? Here's the thing. First, understand that you got stopped out and that's not your fault, okay? Especially if you've designed the stop based on the right way of placing an effective stop, then if you got stopped out, that has nothing to do with you. And here are the 2 emotions that you have to go through. Number 1, as soon as you get stopped out, you have to understand, you have to take a deep breath and say, that's what's supposed to happen, and I'm happy with that. and then immediately get to the next point to say, if this market triggers again, and when I say triggers again, meaning it gives you the confirmation again to move in the direction that you thought it was going to move, then get back into that trade and place an effective stop again. Don't let the fact that you got stopped out from the prior trade in the same market prevent you from getting back into it if it gives you confirmation of entry again. That's a very important thing that we'll cover later, because people do that with stops. Once you get stopped out, you say, I don't want to even look at this market. I don't want to even talk about this market. I don't want to even, I don't want this, I don't want that. It's because people are being emotional. Don't get so emotional when you get stopped out. If the stop is designed properly. The last thing that I want to cover before we finish is, what if the trade goes your way? Which if it's designed right, it should. The market should be moving your way, and then you've placed your stop. What do you do then? Take a deep breath, understand that's a beautiful place to be in. You followed all your rules. After the confirmations, you got into the trade. You placed the stop right after you got in the trade, which you analyzed already before you got in the trade. This is where the stop's supposed to be. Then if the trade moves in your favor, which is supposed to, all good trades, you'll see, if you've ever traded for long enough, you'll know that when you do a trade, the trade that's good will move right away in your favor. Most traders will attest to this, okay? But once it starts moving, your job's not done. You have to now figure out, how do I move my stop? When do I move my stop? What do I mean by move your stop? You have to raise your stop loss, right? Because now you will be reducing the amount of risk that you've taken because the market has moved in your favor, and therefore you have these levels you can raise your stop to. And I will cover that in another video where I go over how do you manage a stop once you've placed it in the market and the market's moving in your favor. How do you go from a stop loss to a break even? When do you do that? How do you do it? What are the ranges? And then from there, how do you take profit? Because it becomes a profit stop, right? So we'll cover that. But for now, I just want to make sure that I covered these important points of placing a stop. What's a stop loss? Why is it important? Always place a stop before any entry trade. Never trade without a stop, okay? And then the common errors people go through when they place stop losses. How do you place an effective stop? I've covered that as well. And then finally, we'll go over in the next series to come, how do you manage a stop once a market starts going in your favor, okay? So until next time, happy and successful trading. Take care.
Content is for educational purposes only. This is not investment advice from Bullionite LLC. There is always risk for substantial losses in investing and/or trading through any financial instrument with or without this or any other type of advertised product. Past performances are not indicative of future results. Different types of investments involve varying degrees of risk. Specific strategies or education presented by Bullionite LLC and its associates in this video are for